Brett, how are we?
Good. How are you doing?
I'm doing pretty good. April's come and gone, so I'm glad not glad it's gone, but it's come and gone.
Well, anybody who's out there tuning in from Michigan understands what that means when he says it's April in Michigan. The weather's crazy, and look at this. We got a stock market that wanted to move around all over the place this month too.
Yeah.
So
probably a highly anticipated podcast, considering the beginning and the end of April is almost the same, and in between was a lot
Quite a
going on.
roller coaster ride,
history was somewhat revisited or made,
Yeah.
in this month of April. So might as well jump right into it.
Exactly.
Get the market update.
Yeah.
We always like to look at the S&P 500, top 500 companies in the U.S. as our gauge of how'd the market do. Well, would it shock you if I told you that we weren't even down 1%? The S&P 500 through the month of April was down just shy of 7.7%, so 0.68% to the downside.
But it didn't feel like that, right?
Day to day, yeah, it was shockingly volatile. But hey, the bond market actually, so we're looking at bonds, fixed income. Those of you retirees tuning in, it's going to make up a portion of your portfolio, generate income, and hopefully provide stability. That has not necessarily been the case for the last few years, but finally we're starting to see those bonds, get back to maybe a more historical role in a portfolio. So aggregate bond index basket of bonds was actually up 0.39% for the month of April. So you got a little bit of a diversified impact there. So it's good.
Well, and we've kind of talked, all year, last 12 months, the whole time we've been doing this, what are we doing within portfolios in general, specifically, a month like April, I know we did some things kind of heading into April.
Yeah.
Anything major in April?
Well, so there was an event. So we had event risk in April. Event risk is one of those that is a little bit more challenging to be proactively anticipating. And, we'll talk about that. Right. But one of the things about finding these volatile environments, you're just looking for smooth air. Turbulence up in an airplane, the pilot's going to find that smooth air and hopefully make your ride a little bit easier. We did look for some smoother air in the month of April. And essentially it amounts to just when you think about investing in companies, which after all, that's what buying stocks is. What you're looking for is the characteristics of the company that you're investing in. So what about like small and medium-sized companies? They're going to be much more dependent upon, is the economy growing? Is it shrinking? They're going to be much more focused on the economics of it all. Where like large, well-established companies, they've got a little bit more thick skin. They can push through kind of those recessionary pressures. So imagine if just finding that smooth air is moving up the food chain, lightening up on some of that mid and small cap exposure in the heat of that volatility, and finding some larger, more well-established companies that rarely are on sale.
Yeah.
And perhaps adding a little bit of higher credit quality in the bond sleeve of the portfolio. Those are elements of finding smooth air, which you've got to be very careful of. And we'll talk about volatility, is not jerking the wheel.
Yeah.
All right. So one of the things that I want to talk about was event risk. You can't set up and just be proactively waiting for that thing that's going to make the market bounce all over the place, because probabilities and statistics would not drive you towards high chances of outcome and success if that's what you're doing. But events do happen, and we call these things tail risks. Tail risks are out of the general probability, but they need to be paid attention to. So rather than being proactive and waiting for them to come, you have to almost react to them. And that's because we're long-term investors. Now, James, what did you say at the top end of the podcast? The market or the month started and finished
about the same.
Okay. So yet again, zoom out. Don't jerk the wheel. Have a disciplined plan in place and execute it.
Yep.
So anyway, we did make some portfolio adjustments, but you had to be there for the bounce back.
Well, and we kind of buried the lead, right? We've touched on it. We've talked a little bit about it just in the first few minutes here, but April was volatile.
Yeah.
Right. And I know that, you, Warren Buffett, a lot of people have different sayings, but in general, what do you think as we look at this volatility bonanza? What really went on? What did you see? What did you hear?
So we're throwing the word volatility around a lot. What is it? It's the price of something moving faster. That's what it is, and perhaps more more range. So it's the price of a stock being more volatile, moving faster, maybe bigger movements altogether. You can give the bonanza definition, but I don't know what that is. But it just means a lot of something, I guess. So there's a lot.
Just trying to get their attention.
Yeah, but realize this, with volatility, oftentimes we associate it with downside movements, but it also is associated with upside movements. And one of the things that happens with volatility is oftentimes the worst days are closely followed by the best days. Mm-hmm. And so you have to meet that volatility environment with, again, a disciplined plan, and understand what the important characteristics of the market are as you're navigating through. But this is where we earn our value. Yeah. And so
absolutely,
volatility was alive and well. And so when you think about what was driving the volatility, we keep talking about this event risk, and we'll touch it a little bit later. But it was the April 2nd announcement of tariffs we haven't seen in the last 100 years, levels at least. And so that was met with movement to the downside that was consistent with COVID impact. We haven't seen movement to the downside like COVID. And then literally a week later, tariffs get paused, 90 days, and we had one of the best days since October of 2008. All in 1 month. Yeah. It's historical.
7 days.
And I think that nowadays with really ultra short-term derivative investments that populate our market, the 24-hour news cycle, things just happen faster, right? And so it was fast. Yeah. It was really fast. So anyway.
Well, we kind of talked, Ryan, about this roller coaster ride, and that we've talked about before, and I've heard you say it's the price of admission into the stock market, and investing. Yeah. When you have these kind of
part of the ride
market events, it's part of the ride. If you jump off, probably going to get hurt, right? So again, not jerking the wheel. We've kind of talked on what's causing the volatility, the event risk, the Liberation Day that followed a few days later with the 90-day pause. But what are some of the underlying themes that we saw throughout the month that really caused a lot of this volatility?
So there's an old expression, reading the tea leaves, and you're just trying to glean information on a number of different levels. And so when you saw the volatility outbreak, it was very interesting and important to watch how things were moving, to be able to kind of anticipate, if we remain in this environment, what we might see continue to play out. So let's look at it. I mean, Liberation Day, April 2nd, where President Trump in the Rose Garden announced 10% blanket tariffs, consistent across all nations. That, in economics, you kind of can absorb that as an economy. Your currency appreciates, and you expect a corporate entity to take on some of that tariff. And so anyway, it's generally accepted that you can absorb a 10% tariff. But then that board came out right. with these punitive reciprocal tariffs that really, quite frankly, when you look at them, look more like trade imbalances than tariffs. That right there was very challenging. And what it did was put other countries on edge, right? Kind of puts a little bit of a wedge between us and our global relations. So if other countries are maybe a little bit upset with me or upset with us, what do you think that they're going to do? They're going to be selling U.S. assets. So in that environment, you would expect, when that volatility spikes, you would expect interest rates to collapse. They went down, and that's why bonds were up marginally. But the reason they didn't collapse is because you did have what we perceive as a lot of treasury bonds being brought to market by foreign entities. Mm-hmm. You saw international stocks remain rather stable, in fact, add to gains, and U.S. stocks drop. Well, if you sell U.S. stocks in a punitive way, that money's got to go somewhere. Right. You saw the price, so international stocks perhaps. You saw the price of gold reach all-time highs, new records. Well, what are you going to do when you're selling these U.S.-based assets? That's kind of your international currency. So really interesting to watch. So now we kind of know, as events unfold here in the weeks to come, you already saw the drill. So that gives us a little bit of intel that we can move forward with.
So along with that, obviously the Trump tariffs, the reciprocal tariffs, was the primary catalyst of all of the volatility.
Right.
Mm-hmm. Members in his administration, Scott Bessent, coming out using the language strategic uncertainty has been a theme, I think, that the administration is talking through. What is it? How does it play out? To maybe take out your crystal ball for us, are we gonna see any trade deals coming in the near future?
I think everyone was searching for what could we coin this strategy. Right at the onset of these the Liberation Day, I created a video. It was like tariff issues, and talked about in there, time is of the essence. We need these things to be used as bargaining chips rather than permanent, policy changes. That would be the best, at least for your portfolio. We can have other conversations, but that's what we're here to talk about, your portfolio, your wealth. And you kind of look at the way that it was brought as a strategic method for getting deals done. And then you look around and go, gosh, it seems a little bit maybe chaotic. Yeah. And then Scott Bessent rightfully says it's strategic uncertainty. So it's a way of bringing this uncertainty to the table to get a foreign nation to say, well, I have no clue how this is going to end. I better figure out.
It's leverage.
I better figure out something here before this spirals out of control. It's definitely different than I think us nice Midwesterners might approach a situation with. But hey, it is what it is. And so we need to understand it's going to come with more volatility. But what did we just hear? That these are probably more bargaining chips than permanent, policy stances. Mm-hmm. Okay? Mm-hmm. So that strategic uncertainty, remember that as you're trying to make sense of this whole policy game playing out here. So,
and past performance isn't always indicative of future results, right? That's always the disclosure on anything, investment related. Mm-hmm. We've talked, water cooler talk, about, the last 5 presidencies. President Trump by far has the most volatile markets. Not that you want to close your eyes and, just pray for what happens, because we don't know what's going to be in the future, and we'll make strategic moves. But, looking ahead, what do we kind of see from that perspective? Even from like the VIX and the volatility, we've talked through, some of the technicals that we look at from volatility and maybe the price movements on the day-to-day. I don't know if we want to touch on some of that.
Let's talk about historical context. I mean, we saw in the month of April a volatility regime that I've really only seen a few times in my 20 plus years of paying attention in this world as it relates to the financial markets at the professional level. So a lot of that got worked out. And I think, one of the topics that I think we wanted to cover here is just what does all that volatility breed, right? Mm-hmm. And so you bring up a point about Trump's last president, his first term. And you get a gap, and then now it's his second term. I saw an interesting chart, and I think I shared it with you, that shows, Trump's first presidential term, and the volatility, and then the total return. So realize that's probably going to come along with the second term. Quite frankly, you're trying to get inside the mind of one individual. Right. I never thought I'd have to read the book Art of the Deal, but I guess to try and get inside his head, we'll do it. We're there. But what do we see going forward? Markets get volatile and price things in. That's what their job is. The stock market is a discounting mechanism. It's looking into the future and trying to discount that future environment into today's terms. Isn't it interesting? In the month of April, we learned that in the first quarter of 2025, the economy shrank. GDP actually came in. Okay? One more of those quarterly contractions, and you have a technical recession. Well, what does the market do in those recessionary environments? It wants to price it in. Okay, so if you were to think about when does that next quarter GDP get released, and then think about is that a recession or not, I would almost wager to think that the market might have priced in some of those recessionary impulses through the month of April. And by the time you get the headline that you're in a recession or something very close to it, the market has already digested it and moved on.
It's a leading indicator.
And remember, things have changed since when I first started in this business. And it's things just happen so much quicker. And so, it was like a a very fast drop to recovery and stuff. But I do think a lot of the digestion is happening right now. So again, I think in this environment, let it play out. There's a couple things to think about. A reset is always important for that next leg of growth. Markets have to check themselves to make sure that they're healthy, make sure that they have strong hands holding the investments. And that, again, will allow the market to be healthier and stronger into that next wave whenever we start that. And I know we're going to talk about like truly looking ahead. What do we feel? But looking at April, it wouldn't surprise me if some of the negativity is baked into the cake.
Yeah.
Yeah. So,
well, that's where we had the swings we did probably. So if we do look ahead then, right? So we're looking at May. Probably have some Fed stuff going on.
No doubt about
it. We still got the tariff kind of situation. What do we see? What do we see in
all
May
that matters
when we circle around and we come back?
All that matters are tariffs right now. That's it.
All right.
It's that big of a deal. And remember, tariffs, what is it? For those of you who just don't even really know what it is, 2 F's, 1 R. Spelling tariff out, right? So that's one thing. But it's a tax. It's essentially a tax on a good that is imported. So when you look at it, it is very destructive from the perspective of it just totally changes the entire trade relationship around the world. And it's not just goods that flow. Capital flows too. Money flows too. So it's very disruptive. I hope that time is of the essence here. Yeah. And we need to get some things solved quickly. But right now, I will tell you, the only thing that matters going forward is tariffs. And tariffs will impact the Fed. It'll impact everything. So
we'll talk more about that in May then.
There you go.
All right. Well, thank you for joining us. As always, good to see the two of you.
Yeah.
We'll see everyone in May.
All right.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.